Okay, the second part of the review session, I'll first examine the short run and long run effect of an increase in money supply on interest rate and exchange rate. And also we will see what happens to output both in the short run and long run when there is an increase. Actually, in the long run, when there is an increase in money supply. So first of all, when money supply increases, the money supply curve, as you can see, it shifts down. The red curve that you see here is a real money demand curve. As the money supply curve shifts down, the interest rate decreases from R1 to R2. So initially, the interest rate was at R1, that was given by the intersection point between the real money demand curve and the initial money supply curve. But now that money supply has increased from M1 to M2, the money supply curve shifts down and the interest rate falls from R1 to R2. Now, quite naturally, even without drawing these graphs, you can imagine what's going to happen in the short run. First of all, because interest rate drops, the investors will start shifting the investments from US to another country where the assets are paying higher interest rates. Therefore, the demand for US currency, that is the demand for dollar, is going to go down, and we know when the demand for a good goes down, the price of that also goes down. So the value of dollar goes down. In other words, the exchange rate increases from E1 to E2. Remember, this is just how we define the exchange rate, and therefore, whenever there is a depreciation of a currency, then the exchange rate increases. So the exchange rate, you'd expect this to increase in the short run, but the thing is, in the short run, the increase in interest rate that we observe, that is from E1 to E2, is actually is an overshooting of the exchange rate. So why do we call that an overshooting of the exchange rate? First of all, if there is no change in expectation about the future price level, then the exchange rate should have increased from E1 to somewhere up here, which corresponds to this point 3. This 3 prime, you see this 3 prime here, so the exchange rate should have actually increased from E1 to somewhere here when money supply increases from M1 to M2, but instead exchange rate in the short run overshoots from E1 to E2. That occurs because when money supply increases, people start forming expectation about inflation in the future. People start expecting higher price level in the future. Now, when people start expecting when people start expecting that the prices are going to be higher in the future, they'll also start expecting the price of the currency, that is the price of dollar, to also be or the price of euro to also be higher in the future. In other words, the expected exchange rate in this formula here, the expected exchange rate is going to rise, and we know that this formula is nothing but just the expected dollar rate of return on a euro deposit. So just to sum it up, if money supply increases, interest rate drops, and at the same time people start expecting that the price level in the future is gonna rise. Although the price level in the short run is sticky, that's why price level doesn't change in the short run, but people, when they see an increase in money supply today, they expect the price level to rise in the long run. As the price level rises in the long run, people also start expecting the price of euro to go up in the future. That is the expected exchange rate between dollar and euro is going to rise now. If it rises now, then the expected return, that is this whole thing, is going to rise. The expected dollar rate of return on a euro deposit is going to rise, and therefore this green curve, which corresponds to the expected euro return, is going to shift upward in the short run. In the short run, when money supply increases, interest rate drops. Simultaneously, the expected euro return, the expected dollar rate of return on a euro bond is going to rise. Therefore, this curve is going to shift up. As it shifts up, it intersects the new interest rate curve, R2 curve, at a higher point 2 prime. Therefore, the exchange rate in the short run overshoots from E1 to E2 instead of going from E1 to somewhere here. Corresponding to the point 3 prime, rather it shoots up to E2 prime, E2, which corresponds to the point 2 prime. So In summary, in the short run, exchange rate overshoots when there is an increase in money supply, and this overshooting of exchange rate happens because people expect the price level to go up in the future. Okay, so that's about the short run. What about in the long run? Well, we know that in the short run price was sticky. The price level could not change. It was sticky, but in the long run prices will adjust to the changes in money supply, and we have learned in the class, and you have also learned this in other macroeconomic courses, that if money supply increases in the long run price level will also increase by the same proportion. That is, if money supply increases by 10%, price level will also increase by 10% in the long run. So that's exactly what's going to happen here. If money supply increases from M1 to M2, then in the long run price level will also rise from P1 to P2 by the same percentage, by the same proportion. As a result, the ratio between the initial money supply and initial price level will be exactly the same as the ratio between the new money supply M2 and the new price level P2. Therefore, as you can imagine, the real money supply will just shift back to the original real money supply curve, to this position. Remember, this was the original real money supply curve. Now in the long run, well, I'm arguing that the price level will increase from P1 to P2 such that the ratio between M2 and P2 becomes equal to the original equal to the ratio between the original money supply M1 and the original price level P1. So essentially what happens is, in the short run the real money supply curve shifts down. In the long run it again goes back from here, from this position to its original position. So the real money supply curve again goes back in the long run to its original position. As it goes back to its original position, the interest rate also comes back to its original position R1. So the interest rate in the short run, it did go down from R1 to R2, but in the long run, because of the adjustment of the price level, the interest rate will just come back to R1 in the short run. As a result, the interest rate curve shifts to the right, which intersects the expected euro return curve at a lower point here, and that gives us the equilibrium exchange rate in the long run. Now, the equilibrium exchange rate in the long run is E3, which is obviously higher than the original exchange rate E1, so which means that in the long run the exchange rate does actually increase. In other words, dollar depreciates. It does depreciate in the long run, just like it did in the short run. But in the long run, the depreciation of dollar is not as much as it was in the case of the short run. In the short run, the exchange rate overshoots from E1 to E2, but in the long run, the depreciation of the exchange rate is such that the equilibrium exchange rate is somewhere between the original exchange rate or the initial exchange rate and the short run exchange rate E2. So it's somewhere in between E1 and E2, this exchange rate in the long run. So just to sum it up, in the short run, exchange rate overshoots when there is an increase in money supply because of inflationary expectation. But in the long run, price level adjusts, and therefore the overshooting of exchange rate, it goes away, and the exchange rate comes to a more moderate position. But exchange rate does increase. In other words, dollar does depreciate in the long run, but not as much as it did in the short run. So what about the impact of an increase in money supply on interest rate in the long run? Well, in the long run, of course, we just saw that it came back from R2 to R1, so there is no impact on interest rate in the long run. That is, interest rate doesn't change in the long run, and output in the long run as well is a function of capital and labor. So as you can see, output Y, it's a function of capital and labor, and it's not a function of money supply in the long run. Therefore, it is independent of money supply in the long run. So even if money supply changes today, in the long run, it's not really going to have any effect on output. So that's about the short run, long run effect of increase in money supply. Next, we will take a look at the impact of a decrease in aggregate real money demand on nominal exchange rate, interest rate, and interest rate R, and price level P. So E here is exchange rate, nominal exchange rate, R is nominal interest rate, P is price level. So again, we have the same curve as before. The top part, as you know, corresponds to the foreign exchange market, and the bottom part of the curve corresponds to the money market, where we have the real money demand curve, and these horizontal curves represent the real money supply curve. Now, suppose that there is a decrease in aggregate real money demand. So initially money demand was at here was given by this L1 curve. Because money demand decreases, the money demand curve shifts to the left. That is, it shifts to L2, and as you can see previously, the intersection point between the money demand curve and the money supply curve was here. Therefore, the intersection point between these two curves gave us the initial equilibrium interest rate R1, and we know that the intersection point between the domestic interest rate curve and the expected rate of return on a euro deposit curve, so that is this curve and this curve, the intersection point between these two curves will give us the equilibrium exchange rate in the foreign exchange market, which is E1. But now that the money demand decreased from L1 to L2, we have a new equilibrium interest rate in US now, which is given by the intersection point between the new money demand curve and the original money supply curve, or the real money supply curve. So this is given by R2. So the interest rate decreases in the short run when we have a decrease in aggregate real money demand. So if aggregate real money demand decreases, interest rate decreases in the short run. As interest rate decreases in the short run, exchange rate rises. In other words, dollar depreciates. The exchange rate increases from E1 to E2. But in the short run, there is no change in the price level. Okay, price level doesn't change in the short run. The thing is, because interest rate decrease, investment will go up in the economy. As investment goes up in the economy, aggregate demand will also go up, because remember, aggregate demand is equal to consumption plus investment plus government expenditure plus net exports. So if investment goes up, aggregate demand will also go up. And we know that if the demand goes up, price level rises. If you think about it in terms of the aggregate demand, aggregate supply curve, then if the aggregate demand curve shifts upward, which means aggregate demand increases, then price level must rise. This is something that you learned in your first intermediate macroeconomic course. So the idea here is the decrease in interest rate leads to an increase in investment, which essentially results in an increase in the price level in the long run. So it's not in the short run. In the long run, price level does rise because of a decrease in money demand. Although in the short run there was no change in the price level, in the long run a reduction in money demand does lead to an increase in price level. So as price level goes up, the real money supply real money supply values, that is the ratio between money supply and price level, should go down. Because if P goes down, this ratio, MS over P, this must also go. If P goes up, if this denominator goes up, then this ratio must go down. Now if this goes down, then the original real money supply curve given by this black horizontal curve here, this will shift up, because real money supply goes down. If it goes down, the money supply curve must shift up here, must shift to the left or shift upward. And it will shift upward to such a point such that the original interest rate, such that we come back to the original interest rate. So remember, in the short run the interest rate dropped from R1 to R2, but in the long run, when money supply shrinks from this black horizontal curve to this blue curve, then interest rate again comes back to its original position, R1. As interest rate goes back to its original position in the long run, the exchange rate again appreciates from E2 to E1. That is, it comes back to its original position. So in the short run, exchange rate depreciates from E1 to E2. In the long run, exchange rate appreciates from E2 to E1. That is, it comes back to its original position. So that's the impact of a decrease in aggregate real money demand on nominal exchange rate and nominal interest rate. And also we have learned that in the short run there is no change in price level, even though there is a decrease in aggregate real money demand, but in the long run there is an increase in price level because interest rate dropped, which spurred investment. As a result, aggregate demand rose, leading to an increase in price level. I hope that clarifies this particular topic. This was actually a question in your written assignment. Okay, next we'll look at the impact of a decrease in aggregate real money demand on real exchange rate. Here we looked at the impact of a decrease in aggregate real money demand on nominal exchange rate. Now we will see what happens to the real exchange rate when there is a decrease in real money demand. Now remember the definition of the real exchange rate. So if Q gives us a real exchange rate, it is equal to the nominal exchange rate times the ratio of price levels in European Union and in United States. So PEU divided by PUS. In the long run, we saw that the exchange rate depreciated, right? In the long run, exchange rate appreciated. That is, it came back from E2 to E1. That is, the value of E went down, right? Exchange rate appreciated, which means the exchange rate went down from E2 to E1. So exchange rate goes down in the long run, E goes down, but at the same time we saw that the price level went up. Here, let's just go back to the previous slide. We saw that price level went up, and so PUS goes up, exchange rate E goes down, and they cancel each other off. Since they offset each other off, the real exchange rate remains unchanged in the long run. In the long run, it doesn't change the real exchange. So there is no impact of a decrease in aggregate real money demand on real exchange rate in the long run. Okay, the next topic is, how does gold standard impose price discipline theoretically? How is it supposed to impose price discipline theoretically? Now, as I discussed in the lecture, there are two different ways theoretically a gold standard should be able to impose price discipline. The first one is the gold standard requires that the money supply is tied to gold stock, so you can't really increase money supply without increasing the gold stock. You can only increase the money supply if the gold stock increases. So that imposes a kind of discipline on money supply, because money supply cannot just grow whenever you just print more money, because it will only grow if you can increase your gold stock. So if money supply is disciplined, then you should expect the price level will also be disciplined, because price level is tied to money supply. We know that. So if money supply can be disciplined by tying it to the gold stock, that essentially means the price level can also be disciplined. So that's the first way. The second way is, even if the central bank increases money supply without adequate gold support, so the central bank, suppose that doesn't have adequate gold to support its increase in money supply, but still it goes ahead with the increase in money supply. It starts printing more money, or just sells or just buys more government bonds. Anyway, it's just increasing more money supply using some method. So even if the central bank increases the money supply, then what essentially happens is the domestic interest in the short run decreases. We have seen that before, that if there is an increase in money supply, then in the short run interest rate goes down. Now when the interest rate goes down, we have said this numerous times, then investors will want to shift their investments to foreign assets which pay higher interest rates, right? So these investors will then sell off the US assets. They will try to convert their investments, they will try to convert their currencies, the US dollars, into gold, so that they can take this gold and invest in other foreign assets. So to invest in foreign assets, domestic currency first needs to be converted into gold. Then these gold could be converted back into foreign currencies before investing in foreign foreign assets. Anyway, what essentially happens here is these investors, when they try to sell off their US deposits and they get back dollars and they want to convert that into gold, they go to the Fed and the Fed supplies this gold to these investors. As a result, gold outflows US, it goes out of US by the amount money supply initially increased. Okay, even though money supply increased initially, it led to a decrease in interest rate, which encouraged the investors to take their money away from US to other countries where assets are paying higher interest rates than the US interest rates. So essentially, gold goes out of US because of uh, all these events. As gold goes out of US, the money supply goes down in the US as well. Okay, so money supply essentially remains unchanged because of this gold outflow. As money supply remains unchanged, price level will also remain unchanged. So that's basically the second method, the second way a gold standard theoretically should be able to impose price discipline. So if you guys have more questions, feel free to reach out to me. If required, I will make a couple more video lectures depending on students' requests. Thank you.